You do the analysis, you identify the trend, you enter a pristine trade. 10 minutes later, a sudden spike clips your stop loss by a single pip, right before the market reverses and rockets 100 pips in your intended direction. It feels incredibly personal. The immediate reaction for most retail traders is to assume the market itself is intentionally hunting down their specific orders to force a loss. But the mechanics are much simpler. Your setup failed because you deployed a static defense line inside a chaotic, constantly moving environment. Placing a stop loss 20 pips away simply because you want to cap your loss at 20 pips treats the market like it cares about your comfort. That distance is entirely arbitrary to the actual reality printed on the chart. To survive as an intermediate trader, you have to discard these comfort-based numbers. The alternative is a dynamic framework that directly maps your risk to the market's current behavior. A stop loss represents the exact price coordinate where your original trade thesis is objectively proven wrong. Instead of random distances, we anchor stops behind structural walls. We place it below a historical zone of buying or selling interest, an order block. By hiding behind this defensive barrier, the market must physically exhaust a massive wall of opposing liquidity before reaching your stop. When you place your stop based on structure instead of hope, your mindset shifts. You force the market to definitively prove your thesis invalid. Structural logic is the baseline, but market conditions shift drastically throughout the day. A 20-pip stop that feels perfectly safe during the quiet Asian session gets instantly shredded by the high volatility of the London Open. This chart illustrates the shift. The short bar shows the Asian session moving 15 pips, while the massive London bar swings 45 pips. Professionals measure this using the average true range. Multiply your ATR reading by 1.5 to establish a volatility-adjusted exit. Expanding your defense to match current volatility ensures your structurally sound trade is never killed off prematurely by standard expected price fluctuations. The immediate fear here is mathematical. If you use the ATR to push a stop loss from 20 pips out to 50 pips, you assume you will lose significantly more money. That assumes your position size remains static. Professional traders use a technique that completely decouples the physical distance on the chart from the actual dollar amount put at risk. This scale balances the formula. If volatility demands a wider 50-pip stop, it weighs against a reduced lot size of 0.20. Inversely, if the stop tightens to 25 pips, the lot size scales up to 0.40. The $100 financial risk stays identical. Your dollar risk is a strict, inflexible budget. The pip distance is merely a fluid variable dictated entirely by the market environment. Once the math is set, there is an operational safeguard you must add. Padding your structural stop by 2 to 3 extra pips prevents the invisible taxes of spread widening and execution slippage from catching your exit. You also have to resist the psychological urge to move that stop to break even the moment you see a profit. Doing this frequently ruins a valid trade right before the market executes a standard breakout retest. And if the market doesn't hit your stop, but flatlines and goes nowhere, implement a time-based kill switch. If your momentum trade remains stagnant for too many candles, cut the dead capital and move on. By constructing a dynamic defense system, you transform your exits into calculated, strategic events. You remove the element of random chance from your performance. The core philosophy of professional risk management is to weather the noise effectively. You give the market just enough room to prove you correct, allowing your analytical edge to actually play out. Stop leaving your capital exposed to arbitrary numbers. Download the FXNX position sizing calculator to master these exact metrics. Then explore the NX Learn Academy and put this dynamic framework to the test on an FXNX demo account.